Mike is 34 years old, lives in Dallas, makes $78,000 a year. By every visible measure, he's doing fine. Nice apartment, new car in the parking lot, good job title on LinkedIn. His savings account has $340 in it, not $3,400, not $34,000, $340. And here's the part that should unsettle you. Mike is not bad with money. He doesn't gamble. He doesn't have an addiction. He doesn't blow paychecks on stupid things. Mike got trapped 3 times by 3 systems that were specifically designed to look like good decisions while quietly draining everything he earned. Today, we're going to walk through all 3 with the exact math, because once you see the numbers, you cannot unsee them. And if you recognize yourself somewhere in Mike's story, that's not a coincidence. It starts 4 years ago. Mike is 30. He's just landed the manager role. His old Civic has 112,000 miles on it. It runs fine. But it doesn't feel like a $78,000 a year car. So Mike walks into a dealership in Plano on a Saturday afternoon. The salesman doesn't talk price. He talks payment. "What are you comfortable with monthly?" Mike says $400. The salesman nods and disappears for 12 minutes. He comes back with a number. $389 a month. New F-150. 3-year-old trade-in taken off the lot. Mike signs. Here's what Mike didn't read in the contract. His Civic had $4,200 left on the old loan. That balance got rolled into the new one. The new truck was $38,000. Add the $4,200 rollover. Add taxes and dealer fees. $2,800. Mike drove off the lot owing $45,000 on a truck that a CarMax sticker would have priced at $38,000. The payment was $389 because they stretched the loan to 72 months. 6 years. Mike felt like he won. 3 years in, Mike is 33. The truck needs new brakes. The infotainment screen is glitching. A newer model just dropped, and the ads are everywhere. He goes back to the dealership. "We can get you into the new one for less than you're paying now." Mike still owes $24,000 on the truck. The dealership values his trade at $19,000. That's a $5,000 hole, called being upside down. They roll it into the new loan. Again. New truck, new 72-month clock. New $415 payment. Slightly higher this time because the hole got bigger. Let's run the math the dealership hid from him. Over 6 years, 2 trucks. Mike handed the bank nearly $29,000 in payments. He still owes $22,000 today. If he had bought an $18,000 used car in cash at age 30, he'd be completely free right now, with money still in the bank. Instead, he's been sprinting on a treadmill for 6 years, paying almost $30,000 to own absolutely nothing. 6 years, $29,000 paid, $22,000 still owed. Net worth from this truck, 0. But while Mike was signing loan number 2, something else was already running in the background. Something smaller, something that feels almost harmless. That's trap 2. And it's the one that will genuinely shock you when you see the number. Mike is 31. The truck is already taking a bite out of every paycheck. But he feels fine. Good job, good credit. Then November comes. Mike's parents visit from Oklahoma. There's a big dinner, Christmas flights for the family. A few gifts he stretched on. The balance hits $4,800. He can't clear it in one shot. So he pays the minimum, $148. The card company sends a confirmation. Payment received. Thank you. Mike moves on. Here's what's happening on the back end that the statement buries in the fine print. The APR on Mike's card is 24.99%. On a $4,800 balance, the bank hits him with roughly $100 in interest that month. His minimum payment is set at $148. Mike pays it. Feeling responsible, here's the brutal reality. $100 goes straight to the bank's profit. Only $48 touches what he actually owes. Next month, Mike buys a $50 tank of gas on the same card. He just erased his entire month of progress. The balance isn't shrinking, it's breathing, and the minimum payment keeps adjusting, always hovering around 2% of whatever he owes. Always feeling manageable, always feeling like progress. It is not progress. It is a subscription to debt. Here's the full math. If Mike makes only minimum payments on that $4,800 balance, never using the card again, it will take him 23 years to pay it off. He will pay $9,400 in interest alone. On a $4,800 purchase, he will pay more than double for stuff he bought before his daughter started kindergarten. Drop a comment right now. Has a minimum payment ever done this to you? Because I want to know how many people watching this have run this math and been genuinely shocked. The illusion is the word minimum. It sounds like the floor. Like the responsible baseline. It's not. It's the exact number the bank calculated to keep you paying the maximum amount of interest for the maximum amount of time. They're not helping you manage debt. They're farming your future income one small, painless payment at a time. Mike is 33 now. He has the truck loan. He has the credit card. And his company just offered him something that sounded genuinely like a gift. An agent came into the office. Nice suit, calm voice. A laminated brochure that said, "Protect your family, build wealth." 2 products in one. Mike is about to walk into trap 3. And this one is the most expensive of all 3 because it hides behind the word responsible. The agent's pitch is smooth, polished. It hits every fear a 33-year-old in Dallas with a family has. Term insurance expires. What happens if you outlive it? With whole life, you're covered forever. Plus, you build cash value. It's like a savings account inside your policy. Forced savings, smart planning. Mike thinks about his daughter. He thinks about what happens if something goes wrong. He signs up for a $500,000 whole life policy. Monthly premium, $280. The agent shakes his hand. Mike feels like a responsible adult. Here's what actually happens to that $280 every month. First, a significant chunk goes to commissions. The agent who sold Mike this policy earned roughly 70 to 100% of Mike's first year of premiums as commission. That's around $2,800 that went to the agent before Mike's money did anything else. What's left gets split. Part covers the actual cost of insuring Mike's life, which for a healthy 33-year-old is cheap. The rest goes into the cash value account, growing at roughly 2 to 3% annually. After 10 years, Mike's cash value is around $14,000. He's paid $33,600 in premiums. Now, here's the comparison the agent never showed him. Term life insurance for a healthy 33-year-old male in Texas, $500,000 coverage, 20-year term, runs about $28 to $35 a month. Call it $30. If Mike had bought term for $30 a month and invested the $250 difference in a basic S&P 500 index fund, historically averaging around 10% annually, after 10 years, he'd have approximately $50,000. Whole life gave him $14,000. Term plus index fund, $50,000. The difference, $36,000 in 10 years. From one decision. Over 20 years, the gap becomes almost obscene. The index fund path compounds to roughly $190,000. The whole life cash value sits somewhere around $42,000. And here's the cruelest detail. If Mike dies, the insurance company keeps the cash value. His family gets the $500,000 death benefit. The cash value he spent 20 years building, gone. Back to the company. If Mike wants to access his own cash value while alive, he has to borrow against it and pay interest on his own money. Whole life insurance isn't protection. It's a wealth transfer disguised as a gift to your family. The math is that simple and that brutal. Mike is 34. Tuesday night in March. His daughter is asleep. He opens a spreadsheet for the first time. Not for work, for himself. He adds up the truck payments, the credit card interest, the insurance premiums, the opportunity cost of money that went somewhere other than his future. The number he writes at the bottom of the page makes him sit very still for a long time. He's lost, not spent, lost. Roughly $47,000 to these 3 traps in 4 years. The hardest part wasn't making the calls. It was admitting that every single decision felt right when he made it. That's what the math never prepares you for. Mike makes 3 decisions. He calls the insurance agent the next morning and cancels the whole life policy, opens a term policy that afternoon for $31 a month, takes the $249 difference, and sets up an automatic transfer to a Roth IRA every month. He calls his credit card company, asks for a balance transfer to a 0% APR card, 18-month promotional period, puts every spare dollar toward that balance for the next 14 months, clears it. He keeps the truck. He's too upside down to get out cleanly right now, but he makes one commitment. This is the last time. When the loan is done, he buys used, in cash, and he keeps it until the wheels fall off. 3 decisions, none of them dramatic, all of them math. The 3 traps didn't work on Mike because he was stupid. They worked because they were designed to look like the obvious, responsible, normal thing to do. Buy a new car, you deserve it. Pay the minimum, it's manageable. Get whole life, protect your family. Every trap comes dressed as a good decision. That's the design. The car payment treadmill sells you the feeling of driving something new. The minimum payment sells you the feeling of staying on top of it. The whole life policy sells you the feeling of being a responsible provider. Feelings aren't free. Mike paid $47,000 for those 3 feelings in 4 years. The math is always there. They just bank on you not running it. Run it. Because the Otter knows the most expensive things in your financial life rarely feel expensive in the moment you agree to them.